Throughout 2025, the motorcycle industry has been shaken by a massive and unexpected shift. Millions of like-new Japanese bikes, Hondas, Yamahas, Suzukis, and Kawasaki's, are suddenly being dumped for pennies at dealer lots and auctions nationwide. Machines with barely any mileage, some still sealed in factory protection, are going for prices veteran riders never imagined possible. And this isn't a one-off case, it's a nationwide pattern. In this video, we break down the chain reaction that caused this oversupply, the decisions behind it, and why riders are feeling the consequences more than anyone else. Stick with us till the very end. Because what's coming next for the motorcycle market might be the biggest twist yet. The market shock. Nobody expected. Practically overnight, like-new Japanese motorcycles began flooding the open market in a way that made veteran riders stop and stare. These were not battered trade-ins or decade-old leftovers. These were machines with barely a season behind them, some still smelling new, lining up in long rows at regional auctions. Riders walking through those lots kept repeating the same startled question. How are bikes this fresh being dumped for this little? What made the scene feel even stranger were the stories circulating among auction staff. Crates marked for dealer distribution were now being redirected straight to wholesale lanes, many still wrapped in their original factory protection. In some regions, entire shipments were rerouted before ever touching a showroom floor. As the numbers grew, the shock turned into disbelief. Veteran techs whispered about units going for prices so low they sounded like typos. People who had spent their lives around motorcycles recognized the weight of the moment. When nearly untouched machines start stacking up like unsold clearance tools, something deeper is out of alignment. No one there knew the cause yet. They only knew the scale was unlike anything they had witnessed since the early 90s glut that quietly reshaped the market for years afterward. And as more trucks rolled in with more pristine models, one truth became impossible to ignore. This was not a small correction. This was a surge. But the shock on the auction floor was only the surface. The real story started much farther back, inside the factories themselves. Japan's factory overbuild problem. Inside the production halls of Japan's largest motorcycle manufacturers, a slow building imbalance had been taking shape long before the market saw the first signs. Production forecasts, crafted in the years before the global shutdown, remained locked in, even as demand patterns shifted dramatically. Assembly lines that had been scaled for steady global growth kept running with the same confidence, unaware that demand would not return in the way planners expected. This was not a matter of negligence or carelessness, it was manufacturing momentum. Once suppliers commit raw materials and once assembly lines are tuned for a specific run rate, changing direction becomes a months-long process. The Big Four had invested heavily in maintaining steady output, expecting that the market would rebound and reward their readiness. Instead, the world slowed. Riders changed their buying habits, and warehouses filled faster than projections could keep pace. What complicated the issue even further was the domestic overshoot inside Japan. Anticipated local demand never materialized. Urban riders held onto older machines. Younger riders delayed purchases. And export channels became the default pressure release valve. Shipments intended for gradual distribution instead became a wave. By the time planners realized how far production had drifted from demand, the system was already swollen. The factories had produced too many units for too long. Inventory needed to move, and it needed to move fast. That pressure pushed manufacturers into a different battlefield entirely, one that had been quietly escalating behind closed doors. If you value straight talk without the corporate filter, make sure you like and subscribe. Add your thoughts below so other riders can see how this market shift looks from your side of the garage. It helps keep these conversations grounded in real experience. The quiet price war inside Japan. Behind the scenes, Japan's major motorcycle brands were engaged in a competition most riders never heard about. Honda, Yamaha, Suzuki, and Kawasaki had been jockeying for global volume dominance for years. But by 2025, the rivalry reached a new intensity. each company pushed to capture more market share by leaning on aggressive pricing strategies designed to undercut the others without drawing public attention. Internal incentives encouraged moving as many units abroad as possible. Volume targets tied to executive benchmarks pushed factories to maintain high output. While these programs rarely made headlines, they shaped the decisions inside boardrooms and export offices. The more each brand pushed to outmaneuver the others, the more the global pipeline swelled. This quiet price war created a chain reaction. Each company feared slowing production, worried that rivals would seize the opportunity to flood markets and gain ground in regions where loyalty can shift quickly. To avoid losing momentum, shipments continued at full speed, even when indicators suggested the demand curve was softening. All of this happened far away from the showroom floor. To the average observer, the brands looked stable and predictable. Behind the curtain, however, each manufacturer felt the pressure to hold position in a fight defined by numbers, prestige, and the desire to project strength. It was a strategy rooted in competition, not in market reality. But even the fiercest price war cannot fully explain why so many bikes ended up unwanted. The final cause came from riders themselves. If this breakdown helps you stay ahead of the curve, your gears and accessories are waiting below. The shift in rider preferences. While factories kept producing familiar midsize and sport models, the riding public was quietly drifting in a different direction. Interest that once centered around traditional Japanese segments began sliding toward categories that barely registered a decade earlier. Retro-styled machines gained momentum. Smaller displacement bikes designed for urban simplicity began attracting younger riders. Lightweight adventure models pulled riders who wanted versatility rather than raw power. Even the used bike market saw a resurgence as riders turned to older machines with proven character and predictable maintenance. With attention scattered across these emerging categories, demand for certain bread-and-butter models softened far more quickly than manufacturers expected. Bikes that once sold with little effort now faced a market that viewed them as less appealing, not because of flaws, but because taste had shifted. When riders look for different experiences, entire product lines can fall out of step almost overnight. The misalignment grew quietly. Factories kept building the models they had always built, while buyers leaned toward machines that felt simpler, lighter, or more nostalgic. The result was a swelling inventory of perfectly capable motorcycles that no longer matched the desires shaping the current riding culture. This shift in preference completed the chain of causes behind the flood of like-new Japanese bikes. Production stayed high, competition stayed fierce, and buyer interest drifted elsewhere, leaving a surplus that no one planned for. With the causes now clear, the next part of the story begins where the pressure finally lands, inside the dealerships. Dealerships jammed with aging inventory. The problems began inside the showrooms, long before the public noticed anything was wrong. Dealerships across the country found themselves packed wall to wall with units that were supposed to move quickly, but instead sat untouched for month after month. Floor plan financing, the backbone of most dealership operations, started applying pressure the moment inventory stayed too long. These financing programs are built around steady turnover, not prolonged stagnation, and every week, a bike sat unsold, drained more money from already thin margins. What was once a manageable monthly cost turned into a tightening vice. Showrooms that normally cycled fresh stock each season began resembling storage warehouses. Rows of identical mid-size models lined the floors, and back rooms filled with crates that should never have accumulated. Sales teams reported difficulty even creating interest because buyers saw no urgency. When people notice a glut, they wait for markdowns, and that waiting erodes dealership stability. The longer units remained, the harder it became to cover the carrying costs imposed by the floor plan lenders. Brand-mandated allocations made the situation worse. Many dealers did not have the option to refuse shipments. Even when they raised concerns about space, financing strain or slowing sales, the trucks kept arriving. Models that were once profitable only in their first season now sat deep into their second or third without movement. By that point, any chance of turning a respectable margin had vanished. The inventory load grew heavier each quarter, and the operational strain became impossible to ignore. And while the inventory problem was painful, the financial systems behind those dealerships were about to absorb an even sharper blow. Financing and residual value systems under stress. The next layer of fallout emerged when lenders and financial institutions began reassessing the value of these oversupplied motorcycles. Residual value assumptions, once considered reliable, no longer held up. Banks saw auction reports showing steep declines and responded by recalibrating their models. When a lender believes a machine will be worth significantly less in the near future, everything changes: the loan terms, the approvals, and the willingness to take risk. Trade-in valuations collapsed almost immediately. Dealers accustomed to offering predictable numbers suddenly found that lenders would no longer back the same figures. A bike that once supported a comfortable trade-in allowance now carried uncertain value on paper, making it difficult for dealerships to structure deals without taking losses. Buyers who arrived expecting straightforward financing encountered new hurdles as lenders tightened approvals on specific models and segments most affected by the oversupply. These shifts strained dealership financing programs in ways many had never experienced. Some lenders raised down payment requirements, others shortened loan terms, and a few paused approvals entirely for certain models until the market stabilized. The result was a bottleneck. Customers hesitated because the deals no longer felt favorable, and dealers struggled because the tools they relied on to close sales had weakened. Even buyers with strong credit found themselves navigating unexpected restrictions. And when dealerships began leaning on wholesale outlets for relief, they discovered those channels were collapsing under their own weight. Auction houses flooded beyond capacity. Wholesale auctions, the traditional safety valve for dealerships overwhelmed with inventory, were pushed far beyond their normal limits. Truck after truck delivered like new motorcycles to facilities already backed up with earlier shipments. The sheer volume was unprecedented. Auction crews struggled to organize incoming units, and some locations reported running out of indoor space entirely. Bikes meant to be temporary overflow became long-term storage. With so many units flooding the lanes at once, selling prices dropped sharply. A machine that would have commanded respectable value a year earlier now struggled to attract even minor bidding interest. Dealers, watching the numbers, realized quickly that sending inventory to auction meant accepting a loss almost guaranteed to exceed any floor plan cost they hoped to escape. But for many, the alternative was worse: letting inventory sit and continue generating debt. The secondary market cracked under the weight of the numbers. Auctions designed to move predictable volumes found themselves running nearly nonstop and still falling behind. This created a loop where excess supply reinforced lower values, and lower values encouraged dealers to offload even more units. Each cycle pushed the market deeper into imbalance, and as auctions buckled, the tension traveled back up the chain, landing squarely between manufacturers and the dealerships they depend on. Tension between manufacturers and dealers. As the crisis intensified, the relationship between manufacturers and their dealership networks began to fray. Dealers who had quietly absorbed growing allocations for years finally reached a breaking point. Some refused new shipments outright, risking penalties to avoid deeper financial strain. Others attempted to renegotiate terms, only to discover that their concerns clashed with corporate expectations built around earlier production commitments. Internal memos circulated, revealing frustration on both sides. Dealers argued that they could not sustain operations under the existing allocation structure. Manufacturers countered that production momentum made reductions difficult without causing larger disruptions upstream. Behind closed doors, conversations grew sharper, and long-standing business relationships began to feel increasingly fragile. Dealers felt blindsided by the rapid oversupply, while manufacturers defended forecasts made before conditions shifted. Neither side accepted responsibility, widening the divide. Communication slowed, cooperation weakened, and routine decisions became drawn-out battles. Even seasoned dealerships admitted the strain was unprecedented. What began as a logistical problem evolved into a structural warning that deeper industry changes were already taking shape. And those deeper shifts would become clearest when the focus moves from the industry's internal mechanics to the riders and owners, who eventually feel the impact in their own garages. Owners watch their bike values collapse. The moment riders realized their nearly new Japanese motorcycles were worth a fraction of their original price, the shock spread faster than any headline. Owners who kept their machines spotless, serviced on time, and stored properly suddenly saw valuations drop in ways that did not seem real. A bike purchased less than 1 year earlier might now be appraised at barely half of what it cost, and in some cases even less than that. For riders who pride themselves on caring for their machines, the emotional hit felt personal. It was not just a number printed on a resale sheet. It felt like an insult to everything they invested into the bike. Depreciation arrived without warning. Riders accustomed to predictable value curves found themselves staring at numbers that looked like errors. Machines that once held their price with dependable steadiness now behaved like disposable goods. Owners who put only a few hundred miles on their bikes, or kept them in like-new condition, discovered that those efforts did little to protect against the sudden drop. The sense of being blindsided was universal. And as riders struggled with collapsing values, another layer of pressure formed when insurance and lending systems adjusted to the new reality. Insurance, lending, and real costs shift hard. Once depreciation numbers began to sink, insurance companies recalculated their payout assumptions. Policies that once guaranteed comfortable replacement values now reflected the lower market environment. Riders filing claims, even for relatively minor damage, encountered revised figures that shocked them. The gap between what they believed their bikes were worth and what insurance was willing to pay widened faster than anyone expected. Loan-to-value mismatches appeared next. A rider who financed a motorcycle 1 or 2 years ago might now owe significantly more than the machine could sell for. Banks recognized the shift and started tightening their rules. Refinancing became more difficult because lenders hesitated to support an asset they now viewed as unstable. Even riders with strong credit histories found themselves forced into higher down payments, stricter conditions, or limited restructuring options. This mismatch put many riders into financially uncomfortable positions. When the bike's value no longer aligned with the outstanding loan balance, every choice became stressful. Selling the bike meant absorbing a substantial loss. Keeping the bike meant continuing to pay a loan that no longer reflected the machine's real-world worth. Insurance adjustments added yet another layer of exposure. If the bike was stolen or declared a total loss, the payout might not cover the remaining loan at all. And while everyday riders struggled with financial pressure, another group faced an entirely different kind of problem. Collectors watching their future expectations evaporate. The collector market takes a hit. Collectors who spent years tracking Japanese motorcycles anticipated steady appreciation for certain models. Limited runs, unique configurations, and clean examples historically held value well. However, the sudden influx of like-new units into the market disrupted the entire collector ecosystem. When too many near-identical machines appear at once, rarity disappears. For collectors, rarity is everything. Models that once seemed destined for future prestige suddenly looked common. Even bikes that were previously celebrated for their engineering or design became overshadowed by the overwhelming volume of similar units released into circulation. A collector who spent significant time and effort maintaining a pristine example discovered that the very qualities once considered special now felt diluted. The long-term mystique surrounding many Japanese motorcycles dimmed quickly. Machines that collectors expected to rise gradually in value now showed signs of stagnation or decline. This shift forced collectors to reevaluate their assumptions about what truly holds value. Year ranges that once appeared significant were reconsidered. Special trims that seemed uniquely desirable lost some of their shine. Collectability relies on scarcity, narrative, and sentiment, and all three weakened. And that psychological shift spread beyond collectors, altering how riders and enthusiasts as a whole viewed the identity and legacy of Japanese motorcycling. The shifting identity of Japanese motorcycling. The crisis reshaped the cultural meaning of Japanese motorcycling. For decades, these machines were defined by reliability, consistency, and the trust built over generations. Riders leaned on those reputations whenever questions arose about long-term durability or value. But with so many like-new motorcycles suddenly losing worth, public perception began to shift. The once unshakable foundation of reliability now carried a new shadow of doubt. Within enthusiast circles, debates intensified. Some argued that the volume collapse did not reflect the quality of the machines, only the imbalance of supply. Others questioned whether the long-standing reputations had grown outdated in a market that no longer behaved predictably. Conversations that once focused on performance or engineering now drifted toward legacy and meaning. Riders asked themselves what these machines represented if their value could collapse so quickly. Heritage pride took a subtle hit. Japanese manufacturers built their identity on precision, discipline, and long-term dependability. The current situation complicated that image. Enthusiast groups that once championed these brands without hesitation now discussed the emotional disconnect created by the crisis. The bikes still performed well, but the bond between rider and machine felt altered. Those deeper questions would fully emerge as the wider market and global landscape began responding in ways no one expected. Rivals move to exploit the opportunity. The stumble of Japanese manufacturers created an opening that rival brands recognized instantly. American and European companies saw a moment where strategic adjustments could shift the competitive balance in ways that normally take years. Once it became clear that vast quantities of like-new Japanese motorcycles were being dumped at unusually low prices, competitors began sharpening their messaging. They emphasized craftsmanship, stability, and long-term value as pillars they believed would resonate amid the uncertainty surrounding Japanese supply. Indian highlighted its steady approach to model updates. Triumph leaned into heritage design with subtle reminders that its production volume had never depended on aggressive oversupply. Harley underscored its domestic identity and consistent output as evidence of dependable brand direction. BMW adjusted its positioning more quietly, focusing on engineering sophistication and refinement, to separate itself from the volatility unfolding in the Japanese segments. Each rival brand seized the moment to frame itself as a safer, strategic bet. In marketing campaigns, showroom language, and broader messaging, the tone shifted toward confidence and predictability. The change was not loud, but it was deliberate. By capitalizing on Japan's stumble, these companies altered how shoppers compared categories. The competitive landscape rearranged itself, with rivals gaining new momentum from a situation they had not caused but were fully prepared to leverage. While competitors repositioned themselves, the global economic environment added pressures that shaped the crisis in ways far beyond branding or strategy. Global tariffs, exchange rates, and economic pressures. Broader economic forces intensified the challenges Japanese manufacturers faced. Japan's currency fluctuations played a major role, especially as the yen weakened against the dollar and the euro. A weaker currency traditionally benefits exporters, but in this case, it created complicated pricing pressures. Lower export costs encouraged continued shipment volumes, even as inventories grew, and the resulting imbalance helped push prices downward at a faster rate. Tariff adjustments across several regions added to the strain. Changing rules on imported motorcycles increased unpredictability in shipping costs and long-term pricing projections for international markets. logistics networks faced their own disruptions. Freight providers adjusted capacity, routing, and scheduling to respond to uneven demand. When Japanese manufacturers continued sending high volumes abroad, carriers had to adapt by reallocating space, raising transport fees, or shifting their planning models to accommodate sudden surges. These changes created new layers of cost pressure that reverberated through every global market, receiving the oversupplied units. Economic conditions varied across regions, with inflation weakening buyer confidence and shifting interest rates limiting financing for distributors. No single factor created the crisis, but together they amplified oversupply, deepened volatility, and accelerated the price instability already spreading through major global markets. While global economics added complexity from the outside, the internal mechanics within Japan's supply chain faced their own destabilizing shock. Supply chain and parts ecosystems react inside Japan. Inside Japan, the supply chain supporting motorcycle production experienced disruptions that extended far beyond finished inventory. Original equipment manufacturers relied on a network of specialized vendors, each calibrated to deliver precise quantities of components. When the yen oversupply crisis took shape, these vendors had to respond quickly. Some cut production cycles to avoid building stock they could not move. Others slowed their operations, anticipating reduced demand from manufacturers who were already sitting on too many finished units. Component suppliers producing engines, frames, electronics, and suspension systems faced particularly sharp adjustments. Their output had been aligned with earlier forecasts built on stable or growing demand. Now, they had to reinterpret those forecasts in light of the sudden inventory glut. This led to trimmed schedules, shortened manufacturing runs, and reconfigured contracts across the ecosystem. Smaller suppliers felt the strain most acutely, as many depended on consistent orders to maintain financial stability. Manufacturers reevaluated launch schedules as unsold units tied up capital. Some future models were delayed, while others merged with existing cycles to cut costs. The ripple hit R&D teams and testing facilities, pushing Japan's parts ecosystem into a more cautious posture. These structural shifts naturally raised an essential question about what the motorcycle market will look like in the years ahead. What this means for the future of the market. The long-term outcomes of the crisis will shape global motorcycling for years to come. Pricing remains the most immediate variable. Forecasts suggest that stabilization may occur once excess inventory clears, but the timelines differ depending on region, category, and competitive behavior. Some analysts predict that prices could rebound modestly by the first half of 2026. Others expect a longer correction, especially in midsize and sport segments that remain heavily saturated. Looking ahead, brands may pivot their production strategies. With the oversupply now fully visible, manufacturers are likely to adopt more conservative forecasting and tighter volume control. This shift may influence design decisions, leading to models with broader market appeal or slower refresh cycles to reduce risk. Engineering teams will also focus on delivering clearer differentiation to strengthen long-term value and prevent future erosion of perceived worth. Buying habits are expected to shift as well. Customers may become more cautious, placing greater emphasis on durability, resale predictability, and brand consistency. Market data suggests that brand loyalty could be reshaped by this event, with some riders choosing stability over novelty. Manufacturers will have to rebuild confidence through transparent communication, restrained production, and product lines designed with long-term integrity in mind. So that's the real story behind the flood of like-new Japanese bikes being dumped for pennies in 2025. It's not just dealers or auctions or factories. It's a chain reaction that riders like us end up paying for if we don't see it coming. Now I want to hear from you. What are you seeing in your town? Are prices dropping where you are, or is this wave just starting to hit? Drop your experience in the comments. And if this breakdown helped you out, hit like, subscribe, and stick around. More rider truth is coming.